Hi everyone, this is Dr. Pradeep Reddy, Associate Professor, Sage University. In this video, I would like to explain you about capital asset pricing model.
So what is this capital asset pricing model? CAPM is a model that provides a framework to determine the required rate of return of an asset and indicates the relationship between return and risk of an asset. Here we are understanding the relationship between return and risk of an asset. And next we have seen the assumptions. So what are the assumptions of this model? First one is market efficiency.
Market efficiency.
And second one is risk aversion and mean variance optimization. And third one is homogeneous expectations. And fourth one is single time period. And fifth one is risk-free rate. And now let us see the next aspect of this model is here, who has developed this and what is that hypothesis that we are framing out and we want to work it out is the hypothesis hypothesizes that investors require higher rates of return for greater levels of relevant risk. That is, they want to take a level of risk for that they want higher rates of returns, and there are no prices on the model. Instead, it hypothesizes the relationship between risk and return for individual securities. Here, since there are no prices that are being mentioned here, and hence we can understand easily the relationship between risk and return for individual securities. Since as an individual, I am identifying what are those securities and I can clearly identify what is the risk associated with it. And it is often used, however, the price securities and investments. And now let us see the next. So here in this simple diagram, you can understand here. What is that? You can see here, you can estimate investment risk. How you can estimate investment risk? Through beta coefficient. What is beta? Beta is indicated as risk. Is beta is indicated as risk? Is beta indicated as risk? Have you heard systematic risk? Unsystematic risk? Have you heard these words?
No, sir.
Okay. In this point of time, I cannot explain and go back what is systematic and systematic, but I can give a short message. What is systematic risk? Systematic risk is market risk, okay, which I cannot avoid as an individual. That is systematic risk. What is unsystematic risk? Unsystematic risk is avoidable risk, which I can avoid that risk by identifying better stocks. Okay, that is unsystematic risk. So here we have to estimate investments risk through beta coefficient. So just keep in mind that beta is treated as risk. Okay, and after estimating that, we have to determine investments required return. How much return do you want? That you have to determine it. I want 10%, I want 15%, I want 20% return from my investment. And once it is decided, then again you have to estimate the investment's intrinsic value. Have you heard these words, intrinsic values, which you might have heard at the point of time value of money, the concepts of time value of money? Just say yes or no. Okay, so these again we have to make an estimate of intrinsic values, and then we have to compare to the actual stock price in the market. In this way, we will be pricing the stock, whether it is relevant to insert that particular stock in the portfolio or not. Okay, and next one is Can you see this diagram? Can you see this?
Yes, sir. Yes, sir.
Yeah. Okay. Let me just frame you what is this diagram. So you can see CML. Can you see CML?
Yes, sir.
That is capital market line. What is that CML? CML indicates capital market line. Okay. CML is capital market line. So in that capital market line, as an investor, I will be identifying the stocks of risky assets as well as risk-free assets also. I will be inserting risky assets as well as risk-free assets also. And here you can see here required return on C, required expected return on A, required return on A, expected return on C. Can you see those? A, B, C. Can you see those points A, B, C? Can you see RF?
Yes, sir.
Can you see ER? Can you see standard deviation of P? Those indicates here RF means risk-free return or risk-free rate. ER means expected return. Okay, standard deviation of P is the risk concept. So here we have to identify and we have to make in an aspect, we have to calculate these stocks in such a way that where we can meet the expected return associated with the risk. By identifying that, we will be getting a line called CML. CML means capital market line. So this capital market line gives us the information about how much amount of stocks to be invested on risky assets and how much amount of stocks to be kept uninvested on risk-free rate. Okay, at this point of time, for the time being, just keep in mind about this. This capital asset pricing model includes CML, capital market line. What is capital market line? The line that explains about the risky and risk-free assets to be included in the portfolio. Is it clear?
Yes, sir.
And next one, I have to move it fast, I think. So here you can see diversifiable and non-diversifiable risk. Here,
Yes, sir.
diversifiable and non-diversifiable risk are associated in order to have an efficient portfolios to be constructed on CML line. Okay, CML line is capital market line. And you can see here the portfolio risk, how we can diversify the risk. You can see here market systematic risk. Can you see my cursor? And this is unique or non-systematic risk, which is avoidable slightly, wherein I can reduce the gap here, wherein this portion of this, can you see my cursor? Can you see my cursor?
Yes, sir.
Yes, sir.
Okay, so this portion cannot be avoidable. This is systematic risk or market risk. And this is non-systematic risk, which can be avoidable by minimizing the risk. And how, see from x-axis to y-axis, how the line is getting down. I'm reducing my risk. That is, I'm identifying the stocks in such a way that it gives my expected return. It is meeting my expected returns. Simultaneously, I'm including my stocks as risk-free rate of stocks, wherein that includes bonds and debentures. So in that way, I am minimizing the risk. And next one, next we have to make it fast. So what is beta? What is beta? What is beta? Anyone? Beta is considered as risk. So
Risk.
there is a yeah, there is an indication given how we have to treat beta and what parameters we have to take into account according to the beta values. If beta is equal to 1.0, what we have to, what is it saying about? What is it saying about? The security has the same volatility as the market as the whole. And if beta is greater than 1, it is saying about it is an aggressive investment with volatile. What is volatility? Volatility is change. Volatility means change with volatility of returns greater than the market. And what is if beta is less than 1.0? It is a defensive investment with volatility of returns less than the market. And if beta is less than 0, see, gives us that an investment with returns that are negatively correlated. So always the best is beta is equal to 1.0. For example, if I get the value of 1.2, if I get the value of beta as 1.2, it indicates me I am taking, what should be the ratio? Beta should be equal to 1. If it exceeds 1, what does it indicates? What does indicates 1.2? That I am taking 20% higher risk in the stock. Okay. And next one is, in this model itself, we have to understand the security market line. One is capital market line and the other one is security market line. So what is the security market line? Here we will be understanding. Can you see SML here? Security market
Yes,
line.
sir.
Security market line is, here we have to understand what are our expected returns, until what expectation, until what mark we can bear the risk. That is security market line. Since we are running in a market where it is consisting of risk, we have to understand what is our bearable risk. So that is security market line. We also should be, why we are investing in fixed deposits? Because I don't want to take risk. Okay. So as a whole, let me summarize you what is this model in a few words. Just try to understand it is a single factor model and it is based on the hypothesis that required rate of return can be predicted using one factor, that is systematic risk. And here we are using SML and CML in order to price these securities, and SML is used to price individual investments and uses the beta coefficient as a measure of risk, and CML is used to diversified portfolios and uses the standard deviation as the measure of risk. So what points you have to remember in capital asset pricing model? Only two things. One is CML and the other one is SML. SML is used to price individual investments. CML is used to diversify portfolio with standard deviation measure of risk. Can you remember these two words? SML and CML. These two words should be seen in your answer if the question is there. Okay. And just write the assumptions.
Yes, sir.
Okay. And don't bother about the challenges of CAPM. Just understand what is this concept.